Hey everyone, welcome back to Broken Models. I'm Tanush.
I'm Jack.
I'm Demi.
And I'm Kale. Thanks for joining us.
So today we're looking at Zillow Offers, a bold experiment that tried to transform real estate using tech, speed, and algorithms. You probably know Zillow as the site you scroll through when you're daydreaming about the houses you can't afford. But behind the scenes, Zillow wasn't showing you listings. They were trying to flip houses themselves, and it didn't end well.
This is the story of how a data-driven company made a very human mistake. They trusted numbers over nuance. Zillow's idea was to automate house flipping using the Zestimate and scale it fast. But the algorithm got it wrong, and the business paid the price.
Zillow Offers lost the company more than $880 million in just 3 years. Thousands of homes were overpaid for, investors panicked, layoffs followed, and in late 2021, Zillow shut the whole operation down.
It's a perfect case study in how a model can look amazing on a spreadsheet, but fall apart in the real world. So today we're gonna going deep into the rise and fall of Zillow Offers and how it became one of the most expensive missteps in recent business history.
Let's kick it off. Before we talk about Zillow's house flipping failure, we need to understand what Zillow was trying to become. Founded in 2006, Zillow was originally a listings aggregator, a platform that gathered real estate data, offered tools for agents, and gave users a fun way to browse homes. But the secret weapon? The Zestimate.
This estimate launched a lot of hype. It gave users an estimate of their home's value based on a model that crunched data from tax records, listings, and past sales. But from the beginning, it had issues. People loved it, but real estate agents didn't trust it. It was fun, but it wasn't always accurate. Still, it became the reason why people kept visiting Zillow.
Then came the bigger dream. Why not use that data and tech to actually become a player in real estate? Not just help you find an agent, but actually buy and sell homes. In 2018, Zillow launched Zillow Offers. It was an iBuyer, a company that makes quick cash offers to homeowners, renovates the homes, and resells them for a profit.
This was the company's bet. They could make home selling easier, more predictable, and less stressful. Homeowners would avoid staging open houses and negotiations. Zillow would give them a cash offer, handle the repairs, and flip the home later. It sounded like a win-win, at least on paper.
And for a while, it kind of worked. Zillow was buying homes in test markets like Phoenix, Raleigh, and Atlanta. They kept their purchases limited, their margins tight, and their algorithm cautious. But as the iBuyer trend exploded and competitors like Opendoor gained traction, Zillow felt pressure to grow faster.
In 2020, they made a major pivot. Zillow Offers became more aggressive. The company shifted from cautious pilot to full-on expansion. They raised billions, hired hundreds of employees, and started purchasing thousands of homes per quarter.
They were buying over 3,800 homes in quarter two of 2020 alone. Think about that. 3,800 homes in 3 months. And these weren't random purchases. They were all made by an algorithm trained to spot opportunities at scale. Zillow was now a real estate investor with deep tech ambitions.
And here's the key point. Zillow wasn't just testing on a business model, they were betting the companies on it. CEO Rich Barton called this the future of Zillow. They were transforming from a media advertising company into a transaction platform, and Wall Street loved it, at least at first.
From the outside, it looked like innovation. Zillow had user trust, name recognition, and tons of site traffic. They believed they had a data edge, that their Zestimate could guide smart acquisitions, fast flips, and low friction sales. They even rolled out Zillow offers alongside mortgage services and title insurance, trying to own every step of the home buying journey.
But the reality was way messier. Zillow was entering a capital-heavy business. They were tying up hundreds of millions in inventory, and they were doing it based on models that hadn't been stress tested during market volatility. The margin for error was razor thin.
And unlike other tech plays, homes aren't digital assets. They can't pivot out of bad inventory. A house needs maintenance. It devalues over time. You can't just fail fast like in software. Every mistake is expensive and physical.
So, as Zillow officers scaled, the stakes got higher. The question wasn't just can we buy and sell homes? It was, can we do this fast enough, accurately enough, and cheaply enough to make money at scale?
And unfortunately, as we'll see next, the answer was no. The tech didn't keep up with the complexity. And the faster Zillow moved, the worse the cracks,
Volatility.
the worse the cracks in the model got. Let's talk about the tech. Zillow built its house flipping empire on the back of its Zestimate algorithm, the thing that claims to predict your home's market value. That's the engine powering Zillow Offers. It was supposed to tell them almost instantly how much to pay for a home and what they could resell it for.
But here's the thing. Predicting housing prices is insanely complicated. It's not like pricing sneakers or books online. Real estate markets are hyperlocal, emotional, and sensitive to economic trends. A estimate can't see the neighbor's broken fence or the smell of mildew within the basement.
Plus, Zillow wasn't just using these algorithms to help consumers. They were using them to make purchases with real money. If their estimate was even 5% too high, that could mean tens of thousands lost per home. And when you're flipping thousands of homes a year, those losses stack up.
In 2021, they went big. Zillow officers went from cautious buying into aggressive growth strategy. They started purchasing more homes faster at higher prices. The algorithm said it was fine, but the market shifted.
Suddenly, supply chain delays made repairs slower. Labor costs jumped. The market cooled slightly, and Zillow was stuck holding thousands of homes they overpaid for and couldn't flip fast enough. The algorithm hadn't predicted that kind of sudden shift.
And it wasn't just about bad timing. Zillow's model was based on volume, which was buy fast, sell fast, but they couldn't move fast enough. They were holding homes too long, paying mortgages, taxes, and maintenance, while the value of those homes dropped.
In fact, in one internal report, Zillow admitted their algorithms had overestimated the value of homes in several key markets, especially Phoenix, Atlanta, and Houston. These weren't minor errors. They were buying homes for way more than they were worth.
So, what's the takeaway here? Tech isn't magic. Algorithms are tools, and they only work if the inputs and assumptions are sound. Zillow assumed that the housing market would remain stable and or keep climbing. When that didn't happen, the whole model broke.
And this wasn't just a tech failure, it was a business strategy failure. Zillow leaned too hard on automation without enough boots on the ground. They thought software could outsmart real estate. Turns out it couldn't. By the second half of 2021, cracks in Zillow's offers weren't just visible, they were gaping. The housing market started cooling, costs were rising, and homes weren't selling at the prices Zillow expected. What started as a tech experiment turned into a financial mess.
Well, let's look at the numbers. In quarter three of 2020 alone, Zillow wrote down over $304 million in losses from unsold homes. They had too many houses on the books, but not enough buyers. That quarter, the company lost more money than it made in the previous 2 years combined.
And it wasn't just a financial hit, it was a brand hit too. Zillow had built a reputation as a consumer-friendly real estate tool, but now the headlines were saying things like Zillow is destroying neighborhoods or Zillow's house flipping fiasco. The company that helped people find homes was now being blamed for artificially inflating home prices and contributing to market instability.
Internally, Zillow was scrambling. They paused home purchases. They laid off 25% of their workforce, around 2,000 employees, in the Zillow Offers division. CEO Rich Barton had to go on record and admit the failure. In his words, we've determined the unpredictability in forecasting home prices far exceeds what we anticipated. That's a fancy way of saying our model didn't work.
It's rare to see a company with Zillow's resources and reputation backpedal that fast. They didn't try to pivot or retool the model. They just shut it down. By November 2021, Zillow Offers was officially over. They sold off remaining inventory at losses. They exited the iBuying business completely.
And Wall Street didn't take it lightly. Zillow stock dropped more than 50% from its peak in early 2021. Investors who once praised Zillow's innovation were now questioning the company's strategy and leadership. It was clear the bet had failed.
And for analysts, this wasn't just a business failure, it was a model failure. Zillow offers prove that even the best data, the smartest engineers, and the strongest brand can't always beat reality. The real estate market is full of irrational behavior, emotional decisions, and unpredictable trends. Algorithms aren't great at handling those.
What makes this collapse even more striking is that it wasn't due to a fraud or scandal. It was a strategic overreach. Zillow genuinely believed in the model, and they were transparent about it, but they underestimated how chaotic and localized housing markets can be. And in business, being wrong at scale is expensive.
So, what's the cost of a broken model? In Zillow's case, nearly $1 billion in losses, thousands of jobs, and a permanent dent in their brand, all because the company thought it could just turn the housing market into a data problem and forgot that every house is a story, not just a number. All right, so let's step back for a second. Zillow Offers was a big idea and it didn't work out, but that doesn't mean it's just a failure to laugh at. There's a lot we can learn from it, especially as students interested in business and technology.
Yeah, well, one of the biggest takeaways for me is that data has limits. Everyone talks about algorithms like they're magic, but real life is messy. The housing market isn't just supply and demand, it's emotions, it's timings, it's location quirks. Can't always quantify that stuff.
And business models need to match the problem. Zillow tried to apply a Silicon Valley style solution to a very offline, hands-on industry. They scaled up before they had proof that the model worked at scale. That's a huge red flag.
It also shows how important it is to pressure test your assumptions. Zillow assumed they could buy more homes quickly and sell them even quicker, but that only works if the market stays hot. One thing shifted, their entire operation collapsed. Their whole system was built on a fragile bet.
And think about the cost of that fragility, not just in money, but in reputation and people. Thousands lost jobs. The stock tanked. Consumers lost some trust. This wasn't just about houses, it was about overconfidence and under preparation.
One lesson for us as future entrepreneurs or analysts is to never get blinded by hype. Zillow believed its own press releases. Sometimes the smartest companies fail because they stop questioning their own model.
And if you're going to use tech to solve a problem, you better understand the human side of that problem too. Real estate isn't just a numbers game, it's people's lives, neighborhoods, families. That's what Zillow forgot.
So, where does this leave us? Honestly inspired. Not because Zillow failed, but because it reminds us that innovation always comes with a risk. The key is to stay humble, test constantly, and build models that respect reality.
And that's why we do this podcast, to learn from failures, not just wins. Zillow tried to do something bold. It didn't work. But the lessons it left behind, those are priceless. We're diving into Theranos next week, a medical tech company that promised to revolutionize blood testing and ended up on trial. You don't want to miss it. Follow us on Instagram at Broken Models Podcast and stream us on Spotify or wherever you get your podcasts. Thanks for
Thanks for
listening to
listening
Broken
to
Broken
Models.
Broken
Models.
Models.